Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and steal your girl. In today's video, we're going to be talking about how savers are still losers in 2020 and beyond. So at the time of this recording, the Federal Reserve just had a meeting and they confirmed that they are not raising rates until at least 2023. So they've said this in the past and done the opposite. However, this is a quote from Federal Reserve Chairman Jerome Powell. He literally said, "We aren't even thinking about raising rates." So this leads me to believe that they are being serious this time. So the point of this video is to piggyback off my last video, which you can see right here, talking about how savers are losers or saving money in 2020 is losing you money. That video it resonated with about 7,700 of you and has just over 250,000 views at this point. But there were about a couple hundred people that did downvote it, and I think they missed the entire premise of the video. So in this video, I want to reiterate a few points and talk about a couple of new things given the new information that the Fed just talked about. So we're going to talk about how this happened in general. It's going to be a quick little history lesson. We're going to talk about the dilemma that low interest rates create. And then finally, at the end of the video, I'm going to give my thoughts on this subject. Stay tuned and watch the whole thing. I always do a little bit of funniness at the end. I think it's funny. You may not think it's funny, but it's my channel, so enjoy, guys. Okay, so how do we get here? How do we get into this situation where interest rates dictate so much of consumer and investor behavior? Here's a very, very quick history lesson, so pay attention. So in 1944, the Bretton Woods Agreement was passed. This was basically where the US dollar was the only national currency directly backed by gold as part of this agreement. All the other countries and currencies that were part of this agreement basically had a gold window to where they could trade their currencies in exchange for physical gold, okay? In 1971, President Nixon basically got rid of the direct convertibility of US dollars into gold, thus severing this tie between the US dollar and gold, aka the gold standard, okay? What this did was it took us from a commodity money, which is basically money that is backed by a commodity, in that case gold or silver, could be backed by pretty much anything, but this commodity was gold and silver, to a fiat commodity, which basically is backed by the government. It has no intrinsic value. They can print it at will, which we've seen during these trying times of stimulus. This basically took it from a fixed rate to a floating rate, which gets us into the next section of this video with the dilemma that this presents. Okay, so what are some dilemmas that this low interest rate environment, what does that do? How does that dictate consumer and investor behavior? Well, the first thing you have to realize is that rates dictate behavior based on how high or how low they are. So think about it logically. Rates are kind of like a lever. I used this example in my last video, which you can see right here. Low rates provide no incentive to save. So think about it. You have a high yield savings account or a money market account earning you maybe 1%. Well, what's the point of keeping all your money in cash in that account if the CPI is 2.5%, 3%, and there's rampant inflation in asset prices such as stocks and real estate? You are literally losing purchasing power by keeping your money in that savings account. Hence, savers are losers, literally. So high rates, they dictate the exact opposite behavior. When your rates are high and you're getting a good return in your savings account for a very low risk, and it's FDIC insured in most cases, you have no incentive to speculate. You don't need to go buy the next Tesla or Nikola or SPAC or whatever you want to call it and gamble your money because you don't need to. You're getting an adequate rate of return because interest rates are high. So that's the first thing. Secondly is that savers are becoming speculators because of this low interest rate environment. I just alluded to this. So this is through a number of different things. So you're seeing FOMO, fear of missing out. People are knowing about this now, that savers are losers with their purchasing power being eroded. So they feel like the regular middle class guy who has no background in finance, who doesn't even know how to read a balance sheet or a 10K or anything like that, which is fine. I'm saying that person has no business investing in individual stocks. The reason I say that is because he's being forced to invest into his 401k, his Roth IRA, his Robinhood account, for example. The reason he feels that need is because he doesn't know where else to invest his or her money, okay? So it's turning people who would regularly be making, let's call it for easy numbers, $1,000 a week. They save 200, they live off 800, everything's peachy, they have savings and their savings account is high, making them money. That doesn't exist in this environment today, so they feel like they need to speculate just to stay with their current lifestyle, if that makes sense. Number 3 is we're seeing inflation in asset prices. Stocks are at an all-time high. Real estate is at an all-time high. We have not seen inflation in the CPI, in the Consumer Price Index, in like, bread or milk, for example, even though there has been an increase in prices, but that's more of a supply chain issue at this point. We're seeing it in asset prices. When people say, Marco, there is no inflation, yeah, have you looked at the stock market lately? Have you looked at price per square foot in your real estate market lately? I guarantee you they're at record highs. So that's number 3. And then number 4, the one that no one talks about except for a few people that I follow on Twitter, it's creating wealth inequality. So that's supposed to be an equal sign with a little dash through it. Wealth inequality runs rampant when interest rates are low or even negative, which we may see in the United States. 90% of the stock market wealth is owned by the top 10% of income producers in the country, and 56% is owned by 1%. So think about that. 1% of the population owns more than half of the stock market wealth out there. Let that sink in. Okay, so let's wrap up the video with my personal thoughts. So are you a loser if you are a saver? Absolutely not. I am personally a saver. I actually put this as the pinned comment of my last video, and people still didn't get the joke. I am literally old school, zero debt. I'm a saver. If I don't have cash in the bank, I'm not going to buy it. And I do understand debt is good in certain cases, okay? But consumer debt, I have none. So in that case, you are not a loser. It shows that you are a mature person who knows how to delay gratification and make purchases when they matter, aka when you have the money in the bank, okay? Number 2, when is enough? So if cash is trash in 2020, which it basically is, when is enough? So I believe wholeheartedly that you should have an emergency fund anywhere from 3 to 12 months, depending on your occupation and your job stability. So 3 months if you're just like a single bachelor, first career, first full-time job, you're living it up, you got a nice car, all that good stuff. Enjoy your time, but put away 3 months of monthly expenses. So if you do have a rainy day, or if you, heaven forbid, get laid off, you at least have a runway of 3 months. If you have a family, I'd recommend 6 months. And if you're an entrepreneur or a commissioned salesperson, I recommend 12 months of runway. Just so if you do, not make a deal, or if you don't sell anything, or if you go out of business, you at least have 12 months of a safety net. And then finally, number 3, what do I invest in if cash is trash? Okay, I got a bunch of money sitting in my savings account. What should I do? Invest in assets. If this meeting was any indicator, the trend is just going to continue. If interest rates are at 0 or potentially even negative, that means asset prices will go up. So that's stocks, that's real estate, that's everything that's gone up historically when rates are low. So right now you have to realize rates are indeed low, and it may even make sense to take out some cheap fixed rate debt. You're locking in 2020 debt and paying that debt off over time, hopefully with higher future income. So you may even want to take advantage of this interest rate environment. So that's my 2 cents. Savers are not losers, but they are literally mathematically losers if they're keeping it into a savings account with a lower interest rate than the cost of inflation. So I hope you got value out of this video. Please share it on Facebook. Please share it on social media. Hit the subscribe button and the bell to get notified. The YouTube algorithm is hating on me. I don't know why. All I do is put out excellent content, in my opinion, and I don't put out videos that are fluff. I only put out videos that are full of value. Thank you so much for watching, and have a prosperous day. And if you want to support the channel, click on all the affiliate links and sign up for all the stuff below. Just kidding. Yeah, but seriously though, guys, I got bills to pay.